Can you tell our viewers a bit about your firm, Front Street Capital, as well as your role there?
So Front Street Capital was created to offer investors an opportunity to invest in innovative, unique, non-index like growth opportunities. We're based out of Toronto. We have offices in Vancouver, Calgary on the East Coast. We manage a little over $1.5 billion of assets under admin, mostly in growth-oriented assets.
What are the funds that you manage?
I was one of the original founders of Front Street Capital, and at the shop I am responsible for some of the growth mandates, the Front Street Special Ops Fund, the Front Street Growth Fund mandate, as well as the Front Street Energy Resource Hedge Fund mandate.
Can you tell us about the long-term investment track record of the Special Opportunities Fund that you manage?
The Front Street Special Opportunities Fund is a bottom-up fund. It's really a stock pickers fund, so we look at different sort of opportunities. We're really looking at early-stage growth opportunities. A fund like that has a history, can be volatile at times, but having said that, I think we're ranked number one over the last 15 years. With
the exception of gold, resource stocks have been in a bear market since sometime in 2011. Is this just cyclical?
Cyclicality has a lot to do with it. And traditionally they've always been cyclicals. And let's face it, the world economy has been through a pretty dramatic sort of shakeup since the credit crisis of 07, 08. And anything that's cyclical, especially resource stocks, have suffered as a result of that. Now we are seeing a world economy that is in much better shape, in fact starting to reaccelerate, and that gives us some hope. But at the end of the day, we remain pretty timid with respect to that whole group, largely as a result of the emerging world countries. Countries like China, for example, while they still continue to grow, they're growing at decelerating rates. So we want to see that sort of flip over. We may see that this year. And China, as a result of the massive growth profile since the 1990s, along with the other BRIC nations, has really driven this whole commodity supercycle over the last 15 years. And so much so that a country like China, for example, consumes almost 40% plus of world demand of basic materials like copper, iron ore, coal, you name it. And so if you're looking to invest in those groups, you have to really worry about the emerging world. Now, we love the energy space for different reasons. Now, while energy has traditionally been a cyclical group and pooled in that same sort of grouping with the cyclicals, what's happening in North America as a result of the shale revolution is really unique, and it has a secular appeal to it that really drives our interest in that group.
If cheap energy is having a game-changing effect on North America, shouldn't resource stocks be flying high?
Energy stocks you would expect to be flying high, and they are, and they're beginning to at the end of the day. And the shale revolution is really recreating America. We think it's recreating the whole industrial base of the North American continent, and it has everything to do with very cheap and abundant molecules of energy, which the whole world consumes at the end of the day. So the petrochemical industry, the industrial industries that consume a tremendous amount of energy worldwide can't compete with the low-cost nature of molecules that we have here in North America. Why are stocks really not reacting? I think it goes back to the general reason why people invest in energy in the past. It's always been cyclical driven, which has been hampered by the economic distress the world has had recently. And it's the worries about China at the end of the day to some degree. And I think that's changing. It kind of reminds me of the period from the latter part of the 80s to the latter part of the 90s. You had a 10-year period where we had a lot of success investing in Canadian growth companies, and who were then taking advantage of changing technology at the time. And then the revolution was in the ability to drill horizontally. That was new. And so you're really exposing your wellbore from vertical to horizontal into continuous sort of reservoir, which was effectively the equivalent of having a lot more straws draining the same pool, kind of stuff like that. So increased productivity, deliverability, and even increased resources. So a lot of successful companies were created during that era, and all they were doing is just effectively exploiting the same, the existing resources that were there. But it all happened, importantly, in an environment where the price of oil was flat for 10 years. So it wasn't driven by commodity price. And this is quite similar. In fact, it's even more pronounced than that, because this new technology, which has opened up these vast resources in North America, is game-changing. But it's coming with tremendous productivity and cost enhancement. The price of doing business continues to come down dramatically. So it's not about the price of oil. which is usually what fuels investors in this kind of space. So I think what investors are going to be facing in the future are a number of great Canadian or North American companies that are growing rapidly in the face of sort of flattish sort of commodity prices. That's what so we're not in this thing for commodity prices, we're in this thing for growth.
What are the big challenges for Canadian energy stocks?
The challenges have been infrastructure. I mean, to some degree, the North American energy sector has been the victims of their own success. What we found are tremendous and abundant low-cost resources, and getting it to market has been challenging. So infrastructure has been an issue, particularly for the Canadians, which are one step removed from getting their products to market. And so they're facing the realities of building pipelines, rail systems, facing opposing environmental groups or native issues or government sort of issues, and at the end of the day, but the private sector is really hard at work. And I think that's one of the things that we're going to be facing this year relative to last year, where then was a negativity with respect to pipeline proposals being pushed back for all the different sort of reasons. I think you're going to see some tremendous amount of things being pushed forward. For example, today you have the southern leg of the Keystone Pipeline, which is now carrying crude today, after having been sort of proposed, planned, built, and now it's in the running 4 years later. So it's now carrying crude from where it couldn't in the past. So it's getting oil to markets at effectively better prices. So, and you're going to see a lot more of these things moving forward, whether it's going to be the Trans Mountain Pipeline that already exists and looking perhaps to double. You're going to see rail activity is responding in a significant way. There could be as much as over 1 million barrels a day of new rail capacity moving oil barrels over the next 12 months. And so the private sector, in the face of challenges, are putting capital to work to rectify some of these problems.
What is your outlook for Canadian energy in 2014?
I think the market's been feeling a lot better in the last 6 months. Canada's been out of favor, period, in the capital markets. The flow of funds have been telling us that for years. And the flow of funds have been moving away from the Canadian market, which is largely resource-based. And it's been flowing away for the reasons we've talked about, the cyclicality aspect of it, the fears about China, the fears about oversupply of crude in North America, all those things at the end of the day. And I think there's greater comfort in the world economy that's now reaccelerating. It's helpful. But on the valuation front, the Canadian stocks have been left behind to a large degree, and I think there's a bit of catch-up to play. I think a lower Canadian dollar also helps. It's devalued by about 10% in the last number of months, which really works well for the Canadian manufacturers. It works really well for the commodity players, which sell their products in U.S. dollars but have all their costs here domestically. So I think there's a great opportunity for a lot of these growth companies that are taking advantage of not only a cheaper way of doing business because of new technology, but with tremendous repeatability given the size and scale of these shale plays. It's incredible. It's game-changing for North America, and it's only happening in North America at the end of the day, which is quite unique. So it's a bit of an arb that's taking place here. So we're on the right side of the arb.
Subscribe to our daily newsletter and be the first to get expert insights and advice from our roster of industry specialists. smallcappower.com, investment ideas and research.